Hi everyone, it's Sabrina, Fox Legal Training. I am recording this video a little late at night on Monday. I've just gone through Opella's offering memorandum, the description of notes, and there were some things that I wanted to share. So I wanted to get this recorded before I go to bed. Anyway, Opella, my goodness. I feel like it could be a case study for all sorts of interesting flexibilities, and I'm going to go through some of them with you now. So, students of Fox Legal Training will remember that I always talk about starting by mapping out your point A. So, what I really want folks to do to start off with is to start with the capital structure chart. So, I'll just go there now. Have a look at the parties, have a look at the other debt in the capital structure, where you sit vis-a-vis that debt. I'm not going to go through that whole analysis. The only thing I want to point out on this page here is the guarantor coverage, because this is one of the pieces of information I tell students they need to get. So as of December 31, 2024, you're looking at guarantors representing 24% of total assets, 40% of liabilities, 69% of adjusted EBITDA. So this is not outstanding guarantor coverage, which means it does raise the risk of structural subordination. So I talk about in the course that what that also means is that you should put a pin in the analysis for non-guarantor debt incurrence. So when you get to the debt covenant, checking whether there are any caps on non-guarantor debt incurrence. As I was going through this, I just always start from the beginning of the description of notes. So I went through and I started, the first thing that I highlighted was an optional redemption. Now, this feels almost quaint to me now that I've been through the whole thing, that I was worried about, not worried, but that I was highlighting these things as being notable, that there was this blended equity and make whole language, which means that if the borrower wants to take out all the notes, they can blend the equity clause and the make whole together, which is a slightly lower redemption, and also that there's this 10% at 103 redemption. I want to highlight those things because I think it's important to note, but it certainly is not what I would consider to be like the biggest red flags for lenders in this deal. I noticed not long after that there is a suspension of covenants provision. So this does appear in pretty much every bond, but what it says is that if the bonds are rated investment grade, then certain covenants will be suspended, so no longer apply, as in the covenant package will look like an investment grade deal. But here we have an additional provision, which I've checked with some colleagues, does appear sometimes in loans, that certain covenants fall away if the borrower can meet a specified leverage ratio. But this is two triggers. So basically, if the following a public offering in respect of equity that does not constitute a change of control, if the borrower has a consolidated senior secured leverage ratio, which using a secured leverage ratio is apparently more uncommon than just a regular leverage ratio. But anyway, if it's less than 4 times, then all of these covenants will fall away. So those two things, public offering, which is not a change of control, plus less than 4 times consolidated senior secured leverage ratio. Now, I personally have not seen that in a bond. And I do know, after checking with some folks who do look at these day in and day out, it is very rare. So this is definitely something that I would flag as being an important consideration for lenders. The other thing I felt was interesting, I'm just going down in the analysis to the debt covenant, that the fixed charge coverage ratio, which is traditionally set at 2 times, and this deal is set at 1.75 times. So the coverage ratio can be lower than 2 times. That's obviously unusual. I went through all the debt baskets, but some of the things that I wanted to highlight. Now, I'm going to put this highlighted version of the offering memorandum on the primary market education series, so you can come through and see everything that I've highlighted. But what I wanted to point out to folks is the contribution indebtedness definition. Now, if you just looked at this and you didn't read the defined term, which obviously no Fox Legal Training student would ever do, you would not realize that this is a 2 times basket. So the borrower can incur 2 times the amount of debt that they receive capital contributions in respect of. So that builds on a 2-to-1 basis. In addition to that, there's also a basket, which is basically sorry, let me just find it. It's a basket that builds based on restricted payments, which I would have called an applicable RP basket. Here we go. And again, you have to go and look at the cross references because I don't have time to record a video that looks at all of that. And obviously Fox Legal Training students know that you really need to follow these cross references. When you're going through the debt covenant, we always talk about pulling out 3 pieces of information. You want to know whether the baskets are available to non-guarantors, the clause number, and the amount and purpose of the basket. So those 3 things. Now, I didn't see, before I get back to this, any limits on incurrence by non-guarantors. So that first point that I made about structural subordination, I think is an important one because guarantor coverage is not particularly high and there are no limits on incurrence of debt by non-guarantors. So this could potentially result in some priming risk. Now, this basket that I'm pointing out here is creating debt capacity in respect of restricted payments capacity at a 2 times amount. So 2 times, right? You can see twice the aggregate amount, which is obviously an easier thing to pick up than going to follow the contribution indebtedness definition. But now there's also lots of other debt capacity here, including a general basket, which is nearly $1 billion, just the general basket. And there is lots more debt capacity here. So I would urge lenders to really add up the baskets. It's the easiest aspect of covenant analysis, is just adding up the monetary amounts of these baskets, and something that you learn how to do in the course. Okay, so for folks who've taken the leverage finance covenant training course, this is going to be a lot easier task to look through these covenants than for people who haven't. Okay, we're going to go to restricted payments now. I highlighted this clause A5 because I wanted to note that is the definition of restricted investment, and that will be important as we go a little later. But the first thing, Fox Legal Training students know, I always check with the build-up basket, is there event of default, and is the fixed charge coverage ratio blocker there? And it is here, okay? It's event of default. It's not material event of default. That is a good thing. These blockers apply to all restricted payments that come out of the builder. That's also a really good thing. Now, the calculation of the builder basket was something that I did flag because there will be no negative CNI deducted from the 50% of CNI that builds the basket, which is one of these situations where the numbers go up, but they don't go down. So that was something that I wanted to point out. In addition to a very large starter amount at 363 million euros or 30% of LTM EBITDA. These look like big numbers to me. I think starter amounts tended in the olden days to be smaller, but folks may suggest that this is market, and it may well be, but it's a lot. So I wanted to point that out. There's a basket for repaying subordinated debt, which I wanted to highlight. There's a basket for payments to repurchase management equity, which is here. So I wanted to highlight that as well. There is a basket for restricted payments following an IPO, set at 7%. And then the very next basket here is the general basket for restricted payments, can be used for any purpose. And it also has a reference to decline prepayment amounts and leverage excess proceeds. So students of the course will know right off the bat, without having to look, what these defined terms mean, and that it means that there is an interplay with the asset sales covenant, which is an important thing to highlight. So the borrower can generate restricted payments capacity, not just cash to make restricted payments, but restricted payments capacity by way of the asset sales covenant. And so this is something that I wanted to flag for everyone. Now, in the restricted payments, we're still in the restricted payments covenant. There is a basket for investments in unrestricted subsidiaries. So I wanted to highlight that. Now, remember, you can add up all of the restricted payments capacity, which is general restricted payments capacity, including this investments in unrestricted subs basket, to determine how much is available for the borrower to invest in unrestricted subsidiaries. Now, I'm obviously old-fashioned, but I do think that this is the sort of deal where a blanket LME blocker would be super useful. because there is a lot of capacity here. And it's the sort of deal where if this is for legitimate business interests, if it's something that the borrower is going to use all this capacity to create value for lenders by creating value in the business, then that's great. Blanket LME blocker is something that was in R.R. Donnelly's deal last year and was, I think, in Getty Images. It certainly was marketed. I'm not sure if it went through, but it would basically restrict the borrower from being able to use all of this capacity for the purpose of liability management. I think that would be such an excellent provision here for lenders to request, because it's almost like asking the borrower to show their cards. And this is the time to do it before the deal is signed. You're basically saying, okay, cool, you've got all this capacity. We don't want you to be able to use it to be able to undermine the most important promise in this entire agreement, which is that you will repay us par maturity, whatever that looks like. That I think would just be so great. This would be a great case study for that. In any event, I'm beginning to lose my voice, so I want to get through this. Again, another basket for restricted payments related to declined excess proceeds. I don't know why we need two, because we obviously already saw the other one. Then we here have restricted payments based on a leverage ratio. This is for any restricted payment, and this was why I noted that the definition of restricted investment was clause A4 of the covenant, because they have here an additional consolidated senior secured leverage ratio for restricted investments, so investments in unrestricted subsidiaries. And this is that it would not be higher, so it would not be worse. It's a no worse than test for the senior secured leverage ratio, or that the consolidated coverage ratio will be equal to or greater than 1.75 times. And again, contract analysis is super important. The difference between an or and an and, it means it's an option. They can pick amongst them, or the consolidated coverage ratio would not be worse. So that's 3 different clauses they can use to qualify investments in unrestricted subsidiaries there. Okay, let's see what else we have. There's an asset sale, application of proceeds, waterfall. I would encourage people to read. I thought 730 days sounded like an awful lot, but that is like the top end of what's market, and this is obviously a top market deal. The definition of additional assets, I wanted to point out, does include CapEx to the extent that folks find that interesting or concerning. There's an excess proceeds threshold at 103 million. Here's the declined excess proceeds definition here. And then below that is the leverage excess proceeds definition, which is also linked to a step down, which will reduce the amount the borrower has to use to apply to excess proceeds offers. Okay, some other things I'll highlight and I'll put up on the platform. There are some net short lender provisions, so focusing on those to the extent this is important. I have also highlighted some EBITDA add-backs, including cost savings and synergies for 36 months, which is the definition of the look-forward period. So the borrower's management can look forward 36 months and anticipate what cost savings and synergies might be realizable. Now remember, this is for calculations made in reliance on that number, on reliance on the estimation of 3 years into the future. And these guys are permitted to add back to EBITDA for purposes of covenant calculation that which they believe they will achieve in terms of cost savings and all of these other aspects here. Bearing that in mind, similarly, new contracts can also be added back. And then I really hope that you all are going to have sight of these documents that are referred to in 24, because the borrower will be permitted to add back anything that was added back in these reports. So page 308 of the OM, I just think that bondholders should be able to look at those documents because they are effectively being incorporated by reference in this clause, this add back to EBITDA. And then I would expect to see this. Any add backs that are made in the offering memorandum will also be permitted to be added back going forward. And then finally, they just state consolidated EBITDA for the end of 2024 is 1.2 billion. It just is that. So there we go. What else do we have? This is where contribution indebtedness is revealed to be 2 times, not greater than twice the amount of. And in the definition of gap, some calculations, these here, the fixed gap terms, will be fixed gap now as of the day of the OM, and then the rest will be floating. So just bear in mind, for purposes of the calculations, that's how it's going to work. Permitted collateral liens, students of Fox legal training will know that I've highlighted this because these are the cross references to the debt covenant basket clauses. And this is why I say to people, when you review the debt covenant, collect those 3 pieces of information, because you won't want to have to keep flipping back and forth. So I'm not going to do that for purposes of this video because it's already very long, but I would encourage you to go and look at these clause numbers and these cross references and be sure that you are comfortable with your collateral dilution to the extent that this will allow. And then I'm just going to hop over to permitted liens real quick, and then I'll go back to permitted investments. These are the cross references to the permitted debt covenant in the permitted liens definition. Would encourage folks to, again, do the cross reference and the calculations of those debt covenant baskets. This is the effective subordination risk that you are taking on by buying this deal. So the amount of debt that could prime you by virtue of the fact that these debt covenant baskets can be secured by assets that do not form part of your collateral. That is the definition of effective subordination. So I would encourage you to come and take a look at that. And then there is quite a generous permitted liens general basket here at 604 million. And then I will go back to permitted investments, and then I'll stop because I do like to try and keep these videos on the short side. I don't want to just go on and on forever, but there's obviously quite a lot to look at here. So we have investments in related businesses for permitted investments in joint ventures, and then there's a general permitted investments basket. So remember, and your friendly covenant analysis service will very likely do this calculation for you, but remember that the borrower can aggregate all of its restricted payments capacity and permitted investments capacity in order to make investments in unrestricted subsidiaries, which is why I made the suggestion that you might consider a blanket LME blocker in this deal. So I'm going to stop there, and I'm just going to thank you if you have made it this far. Well done. I hope that was helpful. I will upload my version of the highlighted offering memorandum to the primary market education series, which is Fox Legal Training's free course to the market for folks who want to learn more about covenants and to use the primary market as a tool, as a way of doing that, as a learning opportunity. That is the whole purpose of it. So as soon as I can get this recording processed and up there, I will let everybody know. Again, hope you found that helpful. Do feel free to get in touch if you have any questions, and I will see you guys at the next one. Thank you.